And it certainly could be another volatile day on Wall Street. Tech, again, looking weak, at least right now. Long way to go. Let's get more guidance and insight with two of our favorite people here on the network, which is Carrie Firestone, Aureus Asset Management Chairman and CEO, and Jenny Harrington, Gilman Hill Asset Management CEO and Portfolio Manager. Both are CNBC contributors. Jenny, I'll start with you. Obviously, what do you make of the recent weakness, and are you using it to pick up any stocks at, a cheaper price, or I shouldn't say cheaper, a less dollar amount than they might have been 2 days ago?
So we're fully invested right now. So no, I'm not buying more as the markets come back. But what I saw in the jobs report this morning was very reassuring. And your earlier guest, Kate Moore, used an excellent word. She said satisfying. I think it was satisfying, both from an investor perspective, where we know what the longer term may look like now, and from a personal perspective, seeing people go back to work and that unemployment number come down. So no, we're not adding, but we have greater confidence in some of the companies in our portfolio that benefit from this, like Unum and American Express and Navient and Ross Stores. So it was a good report for us, and we're happy with the numbers.
Carrie, what about you?
Well, I would agree that a number around 1.4 was excellent. If it was below 1 million, I think the market could be disappointed, and we all should have been disappointed. But, this feeding frenzy we've had over the last few weeks at some point would lead to a tipping point. We're not surprised that the market is coming down, particularly the hard-hit NASDAQ names, the big momentum names. They're up 100%, 200%, so far above their 200-day moving average. And remember, there is no cost to trade, no commissions. Years ago, 5 years ago, 10 years ago, not only would you have a limit how many trades you could make a month, but once you hit that limit or tried to exceed it, the cost would double or even triple. And plus, there are 50% less names, less public companies to buy. That puts a lot of buying pressure on the names that hit the news all the time. Yeah. People are at home, they're remotely working, they're watching CNBC. So they like to buy stocks. So what we think is if the market comes in a little bit more, today would be a time we might, or next week, buy a little Charter Financial, Facebook, CME Group, Waste Connection, American Tower is a name we like. There are a number of names in a low interest rate environment that we think really have a lot of growth. It's not, all the names, but certainly some of the names. We also think at 19 times forward earnings on the S&P, if we're around that 3,200 level, I think that's a stable support level, and we would be comfortable there.
Yeah, Karen, just a quick follow-up. I may have heard this shrunken market theory somewhere in the past. How much do you think the options market is now, for lack of a better term, screwing with the stock market?
Yeah, I think it's a very valid point. We've been hearing about that more in the last few weeks. Huge amounts of option trading, big volumes. And, of course, when you think about how stock splits may have affected the market, some people mathematically think they shouldn't, but if they had, buying options is sort of a cheap way of taking a position in the names that you see on the news all the time and are driving the market higher. So definitely, both on the upside and the downside, it can accelerate moves.
Mm-hmm. Yeah, Jenny, it is, listen, we haven't had a lot of volatility except to the up. We did in March, obviously. I'm talking about in the last couple of months here. Again, people got their fingers on that sell button because they're jumpy from March. How do you navigate? How do you be a therapist to your clients through this? Because they've got battle scars from what happened earlier this year.
Right. So it's funny that because I started writing a letter to my clients last week and I said, hey, I'm writing you this even though there's nothing really going on in the market and it's quiet. And then I had to correct it last night as I'm getting ready to send it out today saying, well, the volatility's returned. But what I think back, remember that the S&P is still up 12%. And a lot of the rest of the market isn't even close. A lot of the rest of the market is still down on the year. So take a step back, take a pause, understand that we're in an actually really wonderful spot right now, given what we've been through, to be basically up a little, down a little, flat. How wonderful for us. So you just need to take that big step back, look at it with historical perspective, take a deep breath, know the companies in your portfolio, know that it doesn't matter if the jobs report came in at 1.4 or 1.2, or 1.5 if you own companies like Cisco or AT&T or Verizon, those are going to do well no matter what. If you own AbbVie or Bristol Myers, companies like that will do well no matter what. So you need to get a little granular, know what's in there, know what you're invested in, and reassess your time horizon. And remember, you're in it for the long run.